Okay, so we're going to move on now. We're going to start looking at our next drivers in our overall endogenous process. We're going to start looking at a very topical situation, very topical in the sense that over the last 5 to 7 years, central authorities, which we'll be looking at now, so specifically central banks and governments, have been very, very involved in the financial markets. Now, when we start looking at this, we have to remember and we have to bear in mind that right now we're looking at the United States from an endogenous perspective. So we're not comparing the United States central authorities' action relative to another countries or currencies. We're looking at it in absolute terms, and we're doing this and scorecarding the central authorities' actions, their reactions, objectively, and we're looking at it from the absolute perspective in the sense that what we want to know is whether their actions are increasing the value of their currency or decreasing the value of their currency overall. Later, when we get to exogenous analysis, we're going to be looking at these, the value of a currency relative to another currency and whether that's decreasing or increasing. But right now we're still in the endogenous process. So do bear that in mind as we're going through this video. And what we're trying to understand here is whether the actions of central authorities are creating overall an inflationary environment or a deflationary environment. And this is how we build out our scorecards, because we want to get a sense of overall what is happening to the US dollar. In terms of our driver, is it driving inflation overall or is it driving deflation overall? And we're not comparing to another country. And bear in mind as well that when we went through foundation earlier on in the video series, we did touch on a few points, and that was to introduce you to how central authorities and how money flows, how they behave and how money flows in and out of the economy. So still remember that we have to look at everything here as an injection and withdrawal and look forward. We use the past data to give us a guide and interpret that correctly to what will most likely happen in the future. So bear those two things in mind. We're looking at it from an absolute perspective. We're scorecarding for inflation and deflation, using historical data, interpreting that, and looking forward. So let's go over to the computer screen, and I'll see you at the end of the video for a conclusion. Okay, so welcome back to the computer screen. We're going to be looking now at our final endogenous analysis scorecard drivers. We're going to be looking at balance sheets and sovereign liquidity. And we're going to be looking at 6 really important indicators or stats to determine whether the behavior of authorities is inflationary or deflationary. So when we're gauging inflation or deflation here, we're looking at the behavior of the authorities in the current time period, and we're getting a snapshot of whether their behavior is currently inflationary or deflationary, or likely to be inflationary or deflationary in the future. And if you remember, on the right hand side of our overall macroeconomic variable analysis, we had our central authorities split up into both governments and central banks. And the 6 drivers we're going to be looking at, we're going to be looking at 5 within the government area, and we're going to be looking at 1 within the central bank area. So the first thing we're going to look at in governments is the government debt to GDP ratio. We're also going to be looking at whether the government is running a surplus or deficit and the magnitude of that surplus or deficit. we're going to be looking at the interest bill, so the bill that the government is currently paying on its debt and the magnitude of that bill. We're also going to be looking at the liquidity cover, so the cover that the government has in terms of paying its bills. So that's basically litmus testing the probability of default or not through the liquidity cover. So what does the government have in order to pay its obligations? And we're also going to be looking at benchmark sovereign rates. So we're going to be looking at the actual interest rates on government bonds. With central banks, we're going to be looking at specifically the central bank's balance sheet. And overall, we can scorecard for each one of these and get an overall scorecard for central authority behavior. That gives us a gauge on the behavior as to whether it's inflationary or deflationary overall on an endogenous basis. Now, these scorecards can be applied to any country or economic common currency area as long as you can get the data. So it's exactly like our previous statistics when we're looking at surveys, money supply, inflation, employment, etc. The theory is all the same. If you can apply it here, you can apply it elsewhere, as long as you can get the data. And we'll be going over to our spreadsheet, endogenous driver analysis soon, to have a look at the actual data, where we get it from and how we analyze it. So all the data is available there. First of all, let's just remind ourselves where we've come from and where we've got to. We're now looking at injections and withdrawals from the reactionary side. So far, we've been gauging inflation and deflation from our leading indicators and through our coincident indicators. And therefore, as we're gauging inflation, deflation from here, we're looking to predict what central authorities are going to do. Now what we're looking at is both fiscal and monetary policy as it stands at this moment in time, to get a snapshot of what they're actually doing. And that will help us gauge inflation, deflation at the current time and moving forward as well. And don't forget, central banks and governments are committed to affecting the coincident drivers here through injections and withdrawals, and the leading drivers predict what the central bank and government's reaction is most likely to be. And coincident drivers lag policy commitment from central banks and governments and the leading drivers. So we have prediction coming in from this side, from our leading indicators. We have reaction to both leading indicators and coincident indicators coming from the right-hand side in the form of injections and withdrawals from the central bank and the government. And right now, we're going to be gauging what they're actually doing, rather than using this data in an attempt to predict what they may do. So this becomes a big head check on the right-hand side to what we're looking at on the left-hand side and in the middle of our overall macroeconomic variables. So let's look at our first driver. We're going to be looking at, first of all, the US government, and we're going to be looking at the debt to GDP ratio. So before we go over to the endogenous driver analysis spreadsheet, let's have a look at why we actually look at this and how we analyze the debt to GDP ratio and the background to it. Well, basically, it comes from tax revenues. That's where it all emanates from. If a government has spent more in the past than they've received in tax revenues, then they're basically injecting more money into the economy than they are withdrawing, and vice versa. And as with all other indicators that we've looked at, injections are inflationary and withdrawals are deflationary. And we can monitor the outstanding debt of a government as a percentage of GDP. And this differs from whether the government is running a current surplus or deficit, which we're going to be looking at later. So what we're looking at now is just the level of all the outstanding debt, not any new debt taken on. A current deficit is when current tax revenues are smaller than current spending, and this adds to the outstanding debt later. The outstanding debt is all spending outpacing revenues from taxes that has been taken on in the past. For example, if the government spent more money than it received in taxes in the past, but is now running a surplus, well, this means they are withdrawing and reducing the debt, and this is deflationary. So a current surplus will actually reduce outstanding debt. So we have to look at these two things in isolation. And we can score outstanding debt as an indicator to inflation or deflation. Our scorecard will be inflationary all the way up the positive side of the scale, because the higher the percentage of debt to GDP is, the more they have to spend in order to maintain inflation or GDP growth, or they risk debt getting out of control and they risk default. So they actually have to go and spend more. So we'll come onto this a little bit later, but the theory is pretty straightforward. The more outstanding debt you have as a government, the more that debt in the past has contributed to inflation and GDP as the overall, as a percentage to the overall economy. That's the most likely scenario. Therefore, if you're running a very, very high level of outstanding debt as a government, to maintain inflation where it's been in the past, you actually have to spend just as much, if not more, in order to maintain inflation and GDP growth at previous levels. So we're going to go over to the spreadsheet now and have a look at where we get this data from and how we start to build our analysis of government debt and the debt to GDP ratio. So let's go over to the spreadsheet, and the tab we want is here in the government file, the government spreadsheet, as part of our overall endogenous driver analysis. If we go over to the sources area, the row that you want is row 25, and you can see all of our central authority drivers here. And if you click here into the government debt to GDP link, you're going to get a whole series of federal government debt variables or data sets. And if we're going to be working out debt to GDP, we want to be looking at total public debt as a percentage of gross domestic product. Or we can take the gross domestic product stats and the total public debt stats. So in your own time, you can actually download those data sets and have a look at the numbers yourself. We've done all the hard work for you actually here, going back to 1966. So we're back into the government tab here, and what we're looking at here is real GDP quarterly and the total debt levels of the government in column C. So we have the date, real GDP, and total debt. And in D, we're simply working out what percentage of debt this value is to real GDP in every quarter. And if you scroll down right to the bottom of the page, you'll see that we go up to recent times, October 2014. To update the data set, all you have to do is put the most recent numbers in. So in your own time, you can go ahead and do that by downloading all of the data. So this is the number we're going to focus on at the moment. Later, we'll come to all of these numbers and we'll come to all of our charts here. So here on the chart, we're looking specifically at the debt to GDP ratio as a percentage. And we can see here going back to 1966, and it's all on the left-hand side, all on one scale. And you can see that we have pretty steady growth up to the early noughties. And then in the early noughties and the mid noughties, it starts to take off. So the government's taking on significantly more debt than in the past. And here we actually have our scorecard for debt to GDP ratio. So the debt to GDP percentage. And you can see here, the higher we go, the higher the level of default risk and the more inflationary we have all the way up our scorecard. And when decreasing the percentage, we have deflationary because these are withdrawals. So positives are injections, inflationary. Negatives are withdrawals, deflationary. And we can go back to our scorecard now. Again, you should be getting very familiar with this scorecard process. We can go back to the presentation and we can have a look at this in a bit more detail. So when we look at the detail of our scorecards, what do we get to? Well, as we looked at briefly in the spreadsheet there, as the debt to GDP ratio increases, economic growth becomes more dependent on public spending. And if public spending were to be cut, this would, all things being equal, reduce the debt to GDP ratio and be deflationary. The debt to GDP ratio can be reduced if GDP just increases by more than the level of spending outpaces tax receipts. So that's a very important thing to note. If, for example, the debt level is increasing and the government is making the conscious decision and choosing to spend more of their tax revenues and outstanding debt is increasing, if GDP increases at a higher rate, then obviously the percentage of outstanding debt to GDP as a proportion of GDP will go lower. So we have to bear that in mind. The point here is that a higher debt to GDP ratio simply means more pressure to inflate, because the only choices are to deflate, which is not desirable, because in deflation you obviously threaten economic growth. Default on the debt, so the debt that's already outstanding, and what we mean by default is not pay the interest on that debt and write the debt off, so cancel the debt, which is not desirable, especially for a country like the United States, because a default would mean the credit rating gets cut drastically, and then they may not be able to borrow on the terms that they want to borrow in the future, or borrow at all. And the last option is to simply inflate further. And historically, when we look at capitalist history, the level of debt to GDP that is really the trouble zone, so where economies start to get into problems or governments start to get into problems in terms of paying their liabilities, as in the interest on that debt, is around 80% historically. And historically, when we look at capitalist economies that have gone through 100% debt to GDP ratio, so right through this scale, the default zone is above 100%. So throughout history, when governments have gone through 100%, there's been a very high correlation to default on the outstanding debt. And when you get to these types of levels, the suppression of interest rates is very necessary above these levels. So the interest bill on the government's debt is kept at a minimum. At levels of 100% plus debt to GDP ratio, governments have very little choice but to inflate, because the other two options, deflate or default, are not desirable at all. So if we just go back to the spreadsheet, we'll have a look at the current number. And the current number for the United States is 100%. Actually above 100%, 102%. And this is basically synonymous with historical cases where debt to GDP levels have gone through 100% and we've seen multiple defaults. So it's not good. It's extremely inflationary. And we have to look at this for what it is. Here, for the United States, we're right at the very top of the scale. So they're currently running a debt to GDP ratio of 102%, which is incredibly inflationary. And they basically have no choice but to make sure that the central bank keeps interest rates low and or increases the money supply in order to print higher levels of inflation and GDP in order to inflate further. So this idea that you can inflate GDP to levels which are increasing at a rate higher than your spending as a government. So you're spending more than the tax receipts that you're receiving, but your outstanding debt is increasing and decreasing as a percentage of GDP. You may have heard this term before in the financial markets or in economics if you've been around these circles, the term of inflating your way out of debt. Well, this is what we mean by that. The US is actually in this position. In our endogenous analysis, we score the highest we possibly can on the inflation scale of +10, giving us a very strong short currency bias. So the US is in this zone of around 100% plus, where inflating further is probably the only option. So this is inflationary for our scorecards. It's inflationary in the extreme, but unlike our other scorecards, we continue to assign a short bias high score because higher levels of debt to GDP require further inflation, because the other two options are just not even an option. Now we're going to look at whether the government is running a surplus or deficit. And as already outlined, if the government is currently spending more than it's receiving in tax revenues, this will continually add to the outstanding debt. And this is inflationary. It continues to be inflationary. Taken together, if the debt to GDP ratio continues to rise and deficit spending continues, the more the government must continue to inflate or risk deflation and or default. So this becomes, again, a self-fulfilling prophecy. And we'll go over to our spreadsheet in a second to have a look at this data, but this is what we have in the United States right now and in recent history. So we're looking back to 1966 here up to present day. And right now, the US is currently running a deficit of minus 2.74% as a percentage of GDP. So what we're doing is taking the deficit number, the surplus or deficit number, and we're working that out as a percentage of GDP. What you can see is that the deficit as a percentage of GDP has actually been recently reducing and is moving in what we would consider to be the right direction. However, do not confuse this with deflationary intentions. It is still actually inflationary if you're spending more as a government than you're receiving in tax revenues. It's just less inflationary than before. Now let's go over to the spreadsheet and have a look at these numbers. If we look at the United States surplus or deficit chart over here, one very easy shortcut is to just go in, select data, and we can see what cells it's referencing. And the column that we're referencing here, with all the percentage data in the cells from 1966 to present day, is column H. And column H is surplus or deficit as a percentage value. So if we just come out of here and we look at how this is worked out, in column H, this percentage number is referencing cells G5 and B5. So B5, we know from earlier, is our GDP number, our real GDP number, but G5 is our surplus or deficit number. And this, when we work it out backwards, is column E minus F. So it's the receipts of the government, tax receipts, minus the outlays, receipts minus outlays. So it's pretty straightforward how we work this out, and then we chart it here going back to 1966. And we can see for most of the time the US government is actually running a deficit. It got very large as a percentage of GDP around 2010, 2011, and it started to come back to more long-term normal levels. But as we know, it's still inflationary, and the outstanding debt has been continually increasing, and that's above 100% debt to GDP. Now, where do we get these numbers from? Well, if we go to the sources section, we click on here, we go back to the St. Louis Fed federal government debt series, and we look for our surplus or deficit statistics. We download these and we work this out as a percentage of GDP. So again, in your own time, you can go to that and work this out, work out where the data is coming from. If we go back to the presentation, we can further understand what's going on here and look to scorecard the situation. Now, it's pretty obvious that the federal government is still spending more than they receive in tax receipts and increasing the outstanding debt and the debt to GDP ratio, stabilizing at around 100%. So we do still have inflationary conditions as evidenced by the deficit, but the deficit as a percentage of GDP is reducing, and therefore outstanding debt is in its growth is slowing down. So it's stabilizing around 100. The problem is the more this continues, the more pressure there is to inflate further. So as we know, it's a perpetual problem. On our scorecard, the deficit score we assign with the minus 2.7% is around a score of 3. So if we take this alone, this is mildly inflationary. But taken together, you can obviously begin to appreciate now how we're overall scorecarding things in the endogenous analysis. Because if you look at outstanding debt and assign a scale of -10 to +10, and you take surplus and deficit and assign a scale of -10 to +10, the overall score, the scale, can come in at -20 to +20, and taken together, we're adding 10 plus 3. So when we take these together, we now have a score of 13 positive on a scale of -20 to +20. So -20 being the most deflationary situation and 20 being the most inflationary situation. We now score 13 combined on these two variables, which is obviously very inflationary. So that's good to understand, because when we start building out our overall scorecard analysis, including all our drivers, we're going to be scoring in a very similar way on a big negative to big positive sliding scale. Now, what about the next driver? The next driver we're going to look at is the interest bill. So why do we look at the interest bill? Well, the way to analyze a country's or economic zone's debt is also to look at the cost of the debt. And the interest rate and the size of the interest bill that a government pays on its debt is important, because it can increase or decrease the size of public expenditure and can therefore directly affect the size of a deficit or surplus. So what we do is we measure the size of the interest bill as a percentage of GDP. And one thing to note here is that interest bills cannot be negative. Therefore, they can only be deflationary in nature. So they only add to withdrawals. If you've got no debt, you pay no interest. So it's just zero. But if you've got debt, you are obviously paying some sort of interest, unless the interest rate is zero. But it can only add. An interest bill can only add. It can only be negative, so it's withdrawing. And it's basically just simply a matter of how deflationary it is. So it can't be inflationary because it's a withdrawal. It can only be deflationary, and it's a matter of how deflationary it actually is. Let's go over to the spreadsheet and see what we're referencing here. If we go back to the government section, we have a look at the interest bill as a percentage of GDP. We'll take our normal shortcut here, select our data, click on our variable, and reference the cell that we're going to be looking at. Reference the column, and we're going to be looking at column J. And if we come out of there, we'll just highlight column J. You'll see all the way down we have our interest bills as a percentage of overall GDP, all the way up to present day. If we scroll back up to the top, we can have a look at the cells this is referencing, and it's referencing cell B as the denominator in our fraction, and cell B, as we know, is our GDP numbers, and the numerator is column I, and column I is our interest bill. And if you follow the link to the St. Louis Fed again, you're going to get the interest bill number. You'll be able to download the data and copy the process of building this spreadsheet. As we can see, the most recent number that we've got in this data set is 1.29%. And we have our scorecard available here, interest as a percentage of GDP. And you can see all of these numbers are basically deflationary, because we can't have an inflationary contributor number from an interest bill as a percentage of GDP that's positive. It can only be zero or positive. So let's go back over to the presentation and have a look at this number. So the maximum score that we're going to be able to assign here in our scorecard for our interest bill is 0. If a country has no debt, they've got no interest bill, and we'll score 0 on this measure. But for the United States, the federal government has a current interest bill running at 1.29% of GDP. And the conclusion here is that this is manageable only because interest rates are so low. All things being equal, if GDP stayed the same, and if interest rates doubled from current levels, this would be incredibly deflationary. So we'd be going up to this point here, so around 2.5%, and it would receive a maximum deflationary score. Because we're on 1.29%, we're going to be scoring around a -4, -6. So right now, we score the United States a -5 on the interest bill, so mildly deflationary. One thing to note is that the interest bill as a percentage of GDP has been coming down overall since the early 90s, with a brief increase in the noughties. So in the early to mid noughties, and it's been coming down. So it's stabilized at low levels, and the levels that it was in the mid to late 70s and late 1960s. So overall, we have to look at these things very objectively. It is deflationary, but it's mildly deflationary. So that sums up the interest bill. Again, think of this in overall scorecard terms, and all of these drivers adding a net positive or a net negative to the overall number. Now let's have a look at the liquidity cover ratio for the United States government. So the liquidity cover ratio, what does it tell us? Well, it's basically a solvency test for the government. So we're testing the government's ability to pay its interest bill. And when we look at this, it actually gives us a good gauge of current and future levels of inflation or deflation. So the ratio basically calculates how many times tax revenues cover the government's interest bill. And if we go into the spreadsheet and look at the data, we're going to find that currently tax revenues are 13.2 times larger in the United States than the government's interest bill. Therefore, the liquidity ratio is 13.2. And we can actually look at this historically. We'll go into the spreadsheet now to get a better understanding of how these numbers are worked out. But if a country's interest bill becomes too large a proportion of tax revenues, then this can mean current or future deflation and can be quite deflationary. So let's go into the spreadsheet first and have a look and understand how these numbers are actually worked out. So if we go to the liquidity cover ratio chart going back to 1966, if we do our shortcut, select data, click on the cells that it's referencing, the column it's referencing, we find that it's referencing column K. So if we come out of there, we can look into column K, look at how this is worked out. The way the liquidity cover ratio is worked out is we're referencing cell E5. So column E, we're referencing federal receipts, so with the tax receipts that the government receives, and we're referencing I5, the actual interest bill. And we're dividing receipts by the interest bill to get our ratio. So let's go back to the presentation, look into this a bit more detail. If you want to understand this in a bit better detail, let's think of the extreme cases so we can understand the dynamics better. Imagine a situation if tax revenues only covered the interest bill by a factor of 1. So whatever the government received in their coffers, so whatever they received in tax revenues, went straight back out again on servicing all outstanding debt. So all the revenues that they received went out to pay the interest bill on the outstanding debt. So what we're looking at here is a situation where the number of tax revenues is equal to the number of the interest bill to service outstanding debt, which gives the number 1, the ratio 1. That basically means that there's no public spending. What would happen in that situation? Well, if you've got a large public sector, basically you can't pay them. Every person in the public sector would lose their jobs, and it would be incredibly deflationary for the economy. But now imagine the other extreme case. Imagine if the interest bill as a proportion of tax receipts was so small that it just didn't matter. So tax revenues, for example, were greater than interest payments by, say, a factor of 100. Well, what that does is actually provide more room in the future for large amounts of public spending. So this can be incredibly inflationary. And if you look at the liquidity cover ratio going back for the United States throughout history, historically the US has had an interest score of around a range from 6 times to 15 times cover against their interest bill. So we can basically look at this and say throughout history that 6 times cover is mildly deflationary, whereas 15 times cover is very inflationary. At only 6 times cover, it means 100 divided by 6. So 16.6% of all tax revenues are leaving the public coffers immediately to service outstanding debt. That's leaving no room for inflationary spending. At 15 times cover, the government has plenty of room to inflate by spending. And if we look at this in terms of building our scorecards, 15 on the scale would give us historically a very inflationary number because it provides a lot of room for future injections. And a 0 or 1 provides a very, very deflationary situation because everything that's coming in is going straight back out. And the US is currently at 13.2 times cover, which means they have a mildly inflationary position when compared to history, when we compare the current liquidity ratio to past liquidity ratios and the range that the US has put in historically for that liquidity ratio. So what we can deduce here is that objectively, the US government can comfortably pay their interest bill and continue current levels of public spending. We're therefore going to scorecard this around a +6 for the current liquidity ratio in the United States. Now, one reason for this is the level the government pays to service their debt, the cost of money. The level of interest rate that they pay to service their debt is obviously important. We've already seen that the level of interest rates in the United States is the lowest it's been in history. And this is helping the government to stay liquid, as in to service the debt and to maintain public spending at current levels, so inflationary. And this brings us on to our next scorecard item for governments. So what level the market is actually prepared to lend money to the government to. And that is the price of money, not through the Fed funds rate, but through the government or sovereign bond lending rates. So the rates that people are prepared to lend to the government. So let's move on to our next variable, our next macro driver, which is government or sovereign bond rates. And what we're going to be looking at is benchmark rates. But first we need to understand what we're looking at here. In our foundation, we looked at the Fed funds rate. We looked at the Fed funds rate earlier when we were looking at interest rates in the United States. The Fed funds rate is a different variable, different mechanism to benchmark sovereign rates. The central bank, in this case the Federal Reserve, as we've already seen previously, can influence the Fed funds rate through open market operations, so the buying and selling of bonds. Ultimately, the rate, though, is determined by the market. However, the Fed can influence the rate in order to reach their predetermined interest rate target. The Fed funds rate, as a reminder, is the interest rate at which depository institutions trade federal funds between each other. So balance is held at Federal Reserve banks trading with each other overnight. And this differs from the rate at which the market is prepared to lend money to the government at. Now, when governments are running deficits, they need to borrow money in order to plug the shortfall between tax receipts and public spending. And the government, to do this, will issue bonds, and the private sector lends money to the government. The rate at which the market is willing to lend money to the government is an indication of sovereign risk, i.e., the private sector gauging the likelihood of ever being paid back. So very low rates mean low risk, and high rates mean high risk. And investors want a higher return on their investment to reflect higher risk. So it's a pretty straightforward theory and understanding and mechanism. And we can look at this in a bit more detail to understand the mechanism and theory behind this. The interest rate of a bond is inversely proportional to the price of a bond. If bond prices are moving higher, this means there is more demand than supply of bonds. Investors are, in this case, prepared to lend at lower rates and vice versa. So the more bonds are in demand, the lower interest rates go. They're prepared to accept lower rates, and vice versa. If bond prices are going lower, the interest rate is going higher, and the interest rate is going higher because this is more reflective of a higher risk. And the Fed funds rate and the price the government pays to borrow money, although it's a different mechanism, they are intimately linked, not because the Fed sets the level directly at which the government borrows, but because of the opportunity cost of the price of money. So imagine if interest rates, the Fed funds rate as set by Fed-sponsored banks, interest rates are very low at the bank, say 0.1%, but an investor can get 5% by lending the same money to the government, and they believe that there is no risk in doing so. So they go out and buy government bonds. Well, if everybody's thinking the same, the price of bonds will rise and the level of interest paid on those bonds by the government will clear at a lower rate, at a market clearing equilibrium rate. So although the Fed funds rate is separate to the interest rate on government bonds, they are intimately linked through the mechanism of the opportunity cost or price of money. So whether we like it or not, the two are intimately linked. Let's look into this further. The benchmark bond in the United States, so the most traded or most liquid government security, is the US 10-year Treasury note. And the current rate of interest, as you'll see in the spreadsheet when you download the data, the current rate of interest for the 10-year Treasury bond is 2.14% at the time of making the video course, meaning the market is basically prepared to lend money to the government at an annual rate of just above 2%, so 2.14%. And we can see by looking at the chart that this is close to recent historical lows. And you can see from our earlier analysis of the Fed funds rate, when looking at it in this context versus the 10-year Treasury rate, that both have been coming down aggressively since the late 1970s, early 1980s. And that's because constant federal deficits, so constant government deficits, large increases in outstanding debt and a high debt to GDP ratio require lower and lower rates of interest to maintain inflationary conditions for continued growth. So the government can basically be allowed to continue to run deficits. So low interest rates are actually required. We can see that now by looking at this in the overall context of our analysis. If we're looking at the current stats in isolation and looking at it very objectively, interest rates are at or near historical lows, and the score that we're probably going to be assigning here is a pretty inflationary score. All things being equal, if the 10-year benchmark rate goes higher, this is deflationary, as it creates a higher interest bill on the outstanding debt, and deflationary withdrawal pressures. So the interest bill that the government is paying goes higher and withdrawals increase. So this is deflationary. If the 10-year benchmark rate goes lower, this creates a lower interest bill on outstanding debt and is inflationary because it allows more room for inflationary spending, so injections. We're going to therefore scorecard the benchmark rate of any country by assigning higher and higher inflationary scores to lower and lower rates. So you can go into the spreadsheet, endogenous driver analysis, and go to the government tab, and you can have a look at where the data comes from in the sources section, and in the government tab you can have a look at how this is all worked out and have a look at the charts and see where the data is feeding from. Now currently the 10-year treasury rate is 2.14%. Therefore we score this on our scorecard as a very inflationary overall number and assign a +8 number. So 2.14%, we're looking here, and as rates go higher, it gets more and more deflationary because the interest bill is increasing, and as we go lower on the 10-year treasury, we're decreasing the interest bill. So at 2.14, we're scoring around a +8. Another factor to note is the direction in which interest rates are moving. So is the market currently seeing net buyers on bonds or net sellers on bonds? If the demand for bonds is increasing, this means that the interest bill will be going lower. And if there's net sellers of bonds, this means the private sector is less prepared to lend money to the government and is demanding higher and higher, or ever higher and higher increasing rates, because they see more risk. So we have net sellers of bonds creating higher rates and higher or lower scores, so a higher deflationary threat. So higher deflationary threat as driven by an increase in interest bill, and lower deflationary threat or inflation driven by a lower interest bill, a decreasing interest bill. So we have to look at this objectively again. And if you think of this in the wider context of what's been happening in the United States, obviously, again, the Fed funds rate and the targets set by the Fed on the Fed funds rate can have an effect on the price the government can borrow money at, so the treasury rate. And if the Fed are very active in the market suppressing the rate, then the government obviously benefits from this. So we're scoring here around a level of 8, because this allows the government to continue to spend higher than the tax receipts that they're receiving, and the interest bill is lower, and therefore this increases the ability of the government to create inflation. So we're scorecarding here an inflationary number of around +8, so pretty high on the conviction stakes. And we can actually go into the spreadsheet to just quickly have a look at the data. Again, this is something you should be getting fairly familiar with now. The tab that we're going into is the T10 percentage tab, so not the government tab. We're going to look at the Treasury data in the T10 percentage tab, and we've downloaded this data from our sources over here. So you can go to the link again and go to the St. Louis Fed to download the weekly 10-year Treasury data. So we go back in here, we have the date, and it's going up in increments of weeks, going back to 1966, all the way down to present day, right at the bottom. And we have our yield on the 10-year benchmark Treasury rate. What we also have is a percentage change on the week, which we'll come to in a second. But you can see here our charts and analysis from the presentation earlier. You can go into these charts and look at where the data is referencing from. We have our scorecard here as well. One interesting thing to look at, which you can look at in your spare time, is the percentage weekly change of the percentage yield. So it's a percentage of the percentage. We can chart the data going all the way back to 1966. And we can zoom in and have a look at the data in more recent times. And what we've worked out here is actually a 12-week moving average in yellow. And the 12-week moving average is giving you a trailing picture of positive or negative weekly percentage changes in the 10-year Treasury rate. And as we know, if the rate is going higher, we're seeing net sellers of bonds. And if the rate is going lower, we're seeing net buyers of bonds. So we can put this into context of any market at any time. What's important here is our scorecard of where we scorecard the actual Treasury rate at the moment in its entirety. So the Treasury rate being at 2.14% gives the Fed a lot of room to inflate because the interest bill is much lower because of a much lower overall interest rate. So we scorecard very highly there in the inflation stakes with high conviction. Now we're going to move away from governments and onto the Federal Reserve. We're going to look at the central bank balance sheet. So why is the central bank, the Fed's balance sheet, important to us? Well, we look at this in a very similar way to government's balance sheets. We look at it as a percentage of GDP. And it's important because it tells us what the central bank's open market operations have been, which are additional to classic M2 money supply. And the Federal Reserve, as we know, has been purchasing bonds since 2008 and as part of an official quantitative easing program. And the official program came into operation in 2010. And we've had 3 rounds of this now, 3 rounds of quantitative easing. And this begins to explain our low rates or inflationary environment as scored by Treasury bonds previously. Because the Fed, through open market operations, have been a guaranteed buyer of bonds, thus creating a low interest rate environment. And you can see here, since 2008, the Fed's balance sheet has increased rapidly as a percentage of GDP from around 6% of GDP to around 25% of GDP, which is a huge increase. The only problem with this is that one day they have to sell these bonds, putting pressure on bond prices and rates upwards. Let's go over to the spreadsheet and have a look at what we mean. So if you come out of the T10 percentage tab here, and we go to sources, to obtain the data, you're looking for the central bank balance sheet as percentage of GDP, so CBBS. And we're going to the St. Louis Fed again, and the data you're looking for is all Federal Reserve banks' total assets, and the code WALCL. So you can go and get that data yourself, no problem. If we go back into the spreadsheet and scroll across, the tab we want is the CBBS tab. And the data that we download is the value of the balance sheet here, all the way up to present day. And this number is quarterly, so released quarterly. And then we have our GDP data in trillions of dollars here, and we just work this out as a percentage of GDP. So we're going back to 2003 here, all the way up to present day. And our data references in our chart from these cells. So we're referencing the percentage column here, so the central bank balance sheet as a percentage of GDP, and on the bottom axis, the date. And as you can see, there's been a big increase since 2008, since the financial crisis, and that's due to the Fed's quantitative easing programs. If we go back to the presentation, we can see and understand how the scorecard has been built. So basically, by being the main purchaser of bonds, the central bank is essentially lending money to the government to finance its deficit and past borrowing. So deficit plus paying the interest on outstanding debt. So we therefore have to treat the scorecard in the same way as we did when we looked at government debt to GDP ratio. So it's basically the same thing. The debt is just being transferred. The point is here that a higher debt to GDP ratio just means more pressure to inflate further, regardless of whether the debt is accounted for as a liability on the Fed's balance sheet or as an asset on the Fed's balance sheet. It doesn't matter what they call it. The only choices are, like when we looked at government debt earlier, the only choices are to deflate, not desirable, or write off or allow the government to default on debt, which is obviously not desirable, or inflate further. So interest rate suppression is really necessary from open market operations from the Fed. So the interest bill on the government's debt is kept low because the government's debt is 100% debt to GDP ratio. So outstanding debt, if you recall from earlier, is at 100% in terms of its ratio to GDP. So governments have very little choice but to continue to inflate. And if the central bank doesn't accommodate this, they basically risk default or asset destruction and possible societal collapse. So now you can see how important this is and why quantitative easing has been so important to the US government, because it's kept interest rates low and debt has shifted across from the government to the central bank. But there's still obligations, obviously, from the government on this debt, and therefore interest rates through open market operations have to be kept low. So we look at it in exactly the same way. And the Federal Reserve's balance sheet is currently 25% of GDP, and therefore receives a 3 on our scorecard, so mildly inflationary. Again, we have to look at this objectively. 25% debt to GDP on the Federal Reserve's balance sheet is obviously very historically high, but it has much more room, if it wants to inflate further, and the pressure is increasing to inflate further all the time, because this becomes a self-perpetuating situation. So that just about wraps it up in terms of balance sheets and sovereign liquidity. Let's go over to the desk for a quick recap. Okay, so welcome back to the desk. We looked at central authorities there, and we looked at both fiscal and monetary levers. And we put, first of all, where this fits into the whole context of the way we're looking overall at all of the different drivers across the economic variable spectrum. And if you recall, we have on the left-hand side our leaders, our leading indicators. In the middle, we have our coincident indicators. And on the right-hand side, we have our central authorities. So that's what we're focusing on here. We're focusing on the central authorities reacting to both leading and coincident indicators, knowing full well as professional traders that central banks and governments are committed to affecting coincident indicators, both economically and politically. So putting that all into context and always keeping this in the back of our minds, we looked at overall 6 drivers, 5 in government and 1 for central banks. So for governments, we looked at debt to GDP ratios, the surplus or deficit, the interest bill they're paying on their debt, the liquidity cover ratio, and sovereign rates. And in central banks, we looked at the central bank's balance sheet, so the Fed's balance sheet versus GDP as a percentage of GDP. And when we got to the end, what you should have started to realize was that when you take all of these things together that are on the right-hand side of our overall economic variable analysis, what's on the right-hand side reacting to what's in the middle and on the left-hand side, so the coincident indicators and the leading indicators, is actually, when you take it all together, very inflationary. And one of the big lessons that we learned there was that the more central authorities actually get involved in terms of creating inflation through pulling the economic levers, the more this becomes a self-perpetuating situation. So the more inflation becomes responsible from the pulling of economic levers, the more they actually have to pull them. So we reflected this in our scorecards. And when we started to build out our scorecards, we had to do this as part of our overall systematic process within our endogenous analysis. And we do this very systematically so we can look at it very objectively and look at it very rationally, so we can actually draw objective and rational conclusions. And overall, the behaviors and the reactions in the last 5 to 7 years from the central authorities in the United States is incredibly inflationary. And also on top of that, the levers that they've pulled and the way in which they've been pulled have created a situation now where basically they have to do it or continue to do it or risk significant deflation. And this is obviously something they don't want. So we're looking at a situation here where a lot of the inflation, jobs, and economic indicators that we've looked at in the past have been affected greatly by monetary policy. And that shouldn't come as a great surprise, but we have to look at this objectively and formally. So in a systematic process. So when we do this, we do it in an endogenous sense, because what we want to know is that on an absolute basis, so not depending on any outside factors, on an absolute basis, is the United States, the US dollar's currency, losing or gaining its purchasing power in absolute terms? And the reaction of the Federal Reserve and the government over the last 5 to 7 years has given us a very strong signal that the US dollar has lost its purchasing power in the past. And moving forward, when we're looking very objectively in our systematic process, we know and realize that because of past actions, that it's actually a higher probability that they're going to have to do this, possibly again. Because a lot of the economic numbers that we've looked at up to this point are actually affected and becoming dependent and more dependent on central authority action, which means they need to do it more. So it's basically telling us that in the past, objectively, the United States has lost its absolute purchasing power, the US dollar, and it's more than likely that it's going to lose it further. That's on an absolute basis. So obviously we're going to move on to exogenous analysis later, where we're going to be comparing the US dollar versus another country, another currency, and we're going to be doing that against the Australian dollar. But what we need first is this endogenous analysis always to get the backdrop as to what's going on, and that will make us more informed in our decision-making process later when we're comparing to other countries. So what we're going to do now, we're going to move on to a recap, and we're going to do two things in our recap. Firstly, we're going to go through the whole endogenous process and add up all of our scores and see the conclusion that we get to. The second thing that we're going to do in our recap is go over everything that we've learned in the video series and all the principles that we're sticking to here. So let's go over to a recap, and then we'll move on to exogenous analysis.